Breaking news that could shake global markets. Japan's government bond yields just hit historic levels, and this threatens to trigger what experts are calling a potential global financial market crisis. The 40-year Japanese government bond yield soared to a record 3.689% on Thursday, while 30-year yields climbed to 2.9114%. These numbers might sound boring, but they represent a seismic shift that could affect every Singapore investor. Here's why this matters for you. Japan holds $1.13 trillion in US Treasury bonds, making it America's largest foreign creditor. That's more money than Singapore's entire GDP for multiple years combined. When Japanese bond yields rise this dramatically, it creates a powerful incentive for Japanese investors to pull money out of US markets and bring it home. In April alone, Japan sold over $20 billion worth of US government bonds in just 2 weeks. This creates what analysts call a carry trade unwind. For years, investors borrowed cheap Japanese yen to invest in higher yielding assets abroad, especially US tech stocks. But as Japanese yields rise and the yen strengthens, this strategy becomes unprofitable. Albert Edwards from Societe Generale warns this could lead to global financial market Armageddon, with massive selling pressure hitting US equities that many Singapore investors hold through their portfolios. The timing couldn't be worse. This Japanese bond crisis coincides with America losing its last AAA credit rating. Moody's just downgraded the US to AA1, citing the $36.2 trillion debt pile and rising interest costs. Federal interest payments will absorb 30% of government revenue by 2035, up from 18% today. All three major rating agencies have now stripped America of its perfect credit score. For Singapore investors, this creates multiple risks. First, if you hold US tech stocks directly or through funds, you could face selling pressure as Japanese money flows home. Second, rising global bond yields affect everything from Singapore bank lending rates to property financing costs. Third, the traditional 60-40 portfolio strategy of stocks and bonds faces serious challenges when both asset classes become unreliable. What should Singapore investors watch next? Monitor the yen's strength against the US dollar. If it continues rising rapidly, expect more volatility in global markets. Also watch upcoming Federal Reserve decisions and whether US Treasury auctions continue showing weak demand.